Thank you for attending Kentucky Public Pensions Authority New Employee Orientation webinar. My name is Jody Carson, and I'm a Retirement Program Manager within the Division of Member Services overseeing our training and outreach programs. We expect the presentation to last approximately 30 minutes, and we will stick around as long as we need to ensure all your questions and concerns have been addressed. During today's webinar, we will have a brief Zoom tutorial, discuss confidentiality, provide an overview of our system's plan funding and participation dates, retirement eligibility, benefit factors, and the benefit calculation. We will also go over medical insurance and member self-service. We will be covering a lot of information today, but hope you find the information valuable and helps you better understand your retirement. At the bottom of your screen, you should see your Zoom toolbar. The three functions available to the attendees are Raise Hand, Q&A, and Reactions. At the far right-hand side of the toolbar, you will notice an option to leave meeting. At any time throughout the presentation, you may exit the webinar by clicking Leave. If you are unable to stay the duration of the webinar, we do encourage you to register for another KPPA webinar in the future. The question and answer function is used to ask general retirement questions to the KPPA representatives. We ask that you be patient with us, but we promise to answer every question before the conclusion of the webinar today. Q&A ensures that no question will go unanswered. To prevent interruption and allow the webinar to end on time, we will not use the raise hand function. While we encourage your interaction with the KPPA staff, we find that oftentimes we will answer your questions throughout the presentation. It's helpful to jot down your questions and ask them at the conclusion of the webinar if those questions go unanswered. Throughout the presentation, we ask that you keep in mind Kentucky Revised Statute 61.661, which requires KPPA to administer accounts in a confidential manner. During today's webinar, we discourage you from submitting questions that are specific to your account and ask that you do not post sensitive information such as your Social Security number, your member ID, or your personal identification number. If you have specific questions, please contact a KPPA counselor at 1-800-928-4646 with your 4-digit PIN to discuss confidential information on your account. Kentucky Public Pensions Authority, or KPPA, was formerly known as Kentucky Retirement Systems for over 60 years. While our agency name and structure has changed, KPPA still employs the same great staff offering you the same great service. Today we'll have an overview of KPPA benefits based on participation date and how you can do more to prepare for your retirement, whether that's next year or 30 years from now. Under the umbrella of KPPA, we administer County Employees Retirement System, CERS, Kentucky Employees Retirement System, KERS, and State Police Retirement System, SERS. CERS and KERS have both hazardous and non-hazardous employees, while SPRS has hazardous employees. Each member is placed in a tier which is specific to their participation date. There are 3 different tiers, and we will get into those tiers in just a while. As you can see, we are a unique and complex pension system. The plan funding is composed of 3 different sources: employee contributions, employer contributions, and the return on investments. We'll take a closer look at the first 2 sources on the next slide, but let's take a minute to discuss the third, which is the return on investments. The CERS and KRS Board of Trustees are charged with the responsibility of investing their system assets to provide for the benefits of the members of the systems operated by KPPA. To achieve that goal, the board follows policies of thoughtfully growing the system's asset bases while protecting against undue risk and losses in any particular investment area. Let's examine the first 2 sources mentioned to better understand how the 3 work together to fund your retirement benefits. Employee contributions are set by statute and depend on the type of service and benefit tier. Non-hazardous employees pay 5% of their creditable compensation, and hazardous employees pay 8%. Creditable compensation is earnings that must be reported to KPPA and is used to calculate retirement benefits. For employees with a participation date on or after September 1st, 2008, an additional 1% is withheld for health insurance contributions, often referred to as HIC. The 1% HIC is non-refundable. Tier 3 non-hazardous employees contribute 5% of their gross salary with an additional 1%, while Tier 3 hazardous employees contribute 8% of their gross salary plus the 1% HIC. Recommended employer contribution rates are determined by KPPA's independent actuary based on data in the annual actuarial valuation. The CERS and KRS Board of Trustees adopt employer contribution rates necessary for the actuarial soundness of the systems governed by the respective boards as required by state law. The KERS and SPRS rates are subject to approval by the Kentucky General Assembly through the adoption of the biennial executive branch budget, and the CERS board sets the CERS contribution rates unless altered by legislation enacted by the General Assembly. See the reference table on this slide to determine the employer contribution rate based on effective date, system, and type of service, or go to our website at kyret.ky.gov and choose Employers and click on the Employee Contribution Rates. As mentioned before, KPPA's benefit structure is dependent upon a member's initial participation date within one of the systems operated by KPPA or one of the other state-administered systems which has a reciprocal agreement under Kentucky Revised Statute 61.680. The member's participation date will determine the benefit tier, which clearly defines requirements for retirement, the calculation used to determine retirement benefits, and more. Tier 1 is for those members with an initial participation date prior to September 1st, 2008. Tier 2 is for members that have a participation date on or after September 1st, 2008 through December 31st, 2013. And Tier 3 is for those members with a participation date on or after January 1st of 2014. Tiers 1 and 2 are considered both defined benefit plans, while Tier 3 is considered a hybrid cash balance plan. As the table states, a defined benefit plan pays benefits based upon a formula, and the benefit is a lifetime payment to the member with the option to leave a lifetime benefit to the beneficiary. Both of these characteristics can be applied to all three tiers administered by KPPA. A hybrid cash balance plan obviously shares some characteristics of a defined benefit plan, but it also possesses characteristics of a defined contribution plan, such as a 401k or a 457. Like a defined contribution plan, a hybrid cash balance plan determines the value of benefits for each participant based on individual accounts. Now let's move on to discuss how the retirement eligibility requirements differ based upon the benefit tier structure. To retire with full retirement benefits, meaning no penalty is calculated to reduce the benefit amount, a non-hazardous member is required to meet one of the following criteria. He or she must have 27 years of service regardless of age, or reach the age of 65 regardless of service. Notice I mentioned only one of those requirements must be met to reach retirement eligibility. Hazardous members may retire with 20 years of service regardless of age or reach age 55 regardless of service. Tier 2 and Tier 3 members have the same eligibility requirements for normal or full retirement benefits. Non-hazardous members must retire under the Rule of 87 or age 65 with 60 months of service. The Rule of 87 states that a member must be a minimum of 57 years old and their age plus their service must equal 87. For example, if a member wishes to retire at the earliest age allowed, they would need 30 years of service to add to their age of 57, which would satisfy the Rule of 87 requirement. 57 years old plus 30 years of service equals 87. Hazardous members must attain 25 years of service regardless of age or have reached age 60 with 60 months of service. Tier 1 and Tier 2 members have the option to retire early with a penalty to reduce their retirement benefit. For Tier 1 non-hazardous members, at least 25 years of service but less than 27, regardless of age, or age 55 with 60 months of service is the eligibility requirement. For hazardous members, it's age 50 with 180 months of service. Tier 2 non-hazardous members may retire with a reduced benefit at age 60 with at least 120 months of service, while Tier 2 hazardous may retire at age 50 with at least 180 months of service. Tier 3 members are not permitted to retire early and therefore must meet the requirement from the previous slide or take a refund of their accumulated account balance. As we discussed earlier, the 3 benefit tiers retirement calculations are based upon a formula. For Tier 1 and Tier 2, the same formula is used, but the variables within the formula differ. We'll discuss those differences in the upcoming slides. So for Tier 1 and Tier 2 members, the calculation for retirement is final compensation multiplied by a benefit factor multiplied by the member's years of service. For Tier 3 members, the calculation to determine retirement benefits is the member's accumulated account balance divided by an actuarial factor. Let's break these formulas down based upon benefit tier. The first component of our formula is final compensation. For Tier 1 non-hazardous members, the final compensation is based on the highest 5 fiscal years with the highest monthly average, while hazardous members is based on the highest 3 fiscal years with the highest monthly average. Partial years may be used to determine the average of these salaries if the partial year represents a higher monthly average in wages than the monthly average of the previous years, which may contain a full 12 months of service. It's also important to note that there must be a minimum of 48 months in the calculation for non-hazardous and a minimum of 24 months in the calculation for hazardous. As you can see, to determine the final compensation, the highest fiscal years of salary based upon the member's type of service is added together and then divided by the number of months represented over those years to determine the member's average annual salary or final compensation. This number is then multiplied by 12. So for the hazardous example, this member's final compensation is $45,120, while the non-hazardous example's final compensation is $29,340. So now that we know how to determine the first component of the formula, let's move on to the second, which is your benefit factor. The second part of our formula is the benefit factor. The benefit factor is determined by statute and based upon the system and the type of service. There are several benefit factors for KERS non-hazardous and CERS non-hazardous, so be careful to review which one you apply to your benefits. If there's ever any doubt, you can calculate your benefits on member self-service, which will use the correct benefit factor, or you can look at your online annual statement for guidance. On the next slide, we will put it all together to determine the annual benefit for our member. To complete the calculation, the member would determine their total years of service and then multiply by the appropriate final compensation and benefit factor. On the screen, you will see how we use each component to arrive at our annual basic benefit amount. For our non-hazardous example, let's assume this member is CERS with a participation date of August 1st, 2005, and is retiring effective August 1st of 2032 with 27 years of service. We determined earlier that this member's final compensation is $29,340. So in order to calculate the benefit, we would take $29,340 multiplied by 2% multiplied by 27 years to arrive at $15,843.60 per year. For our hazardous example, let's assume this member is KERS and retiring with 20 years of service. We determined earlier that this member's final compensation is $45,120. So in order to calculate the benefit, we would take $45,120 multiplied by 2.49% multiplied by 20 years to arrive at $22,469.76 per year. As I mentioned, logging into Member Self-Service would not only project the member's first eligible and first unreduced retirement date, but it will also calculate the member's retirement benefits based on the information that a counselor would use to calculate benefits in office. It will also include any penalties associated with an early retirement. For Tier 2 members, the calculation is also final compensation multiplied by the benefit factor multiplied by the total years of service. Final compensation for Tier 2 non-hazardous is based on the last 5 full fiscal years of salary, while hazardous members is based upon the highest 3 full fiscal years of salary. Unlike Tier 1, partial years will not be used to determine the average of these salaries. It's important to note for Tier 2 final compensation that there must be a minimum of 60 months in the calculation for non-hazardous and a minimum of 36 months in the calculation for hazardous. Again, to determine the final compensation, the full fiscal years of salary based upon the member's type of service is added together and then divided by the number of months represented over those years. To determine the member's average annual salary or final compensation, you then multiply by 12. So for the hazardous example, this member's final compensation is $44,000, while the non-hazardous example's final compensation is $42,100. The benefit factor is again determined by statute and based upon the type of service and the amount of service. I won't go into each tier of service credit at retirement, but notice the more service with which you retire, the higher the factor is. I do want to point out that for those non-hazardous members that work beyond 30 years, the higher 2% factor is only applied to those years that are in excess of the 30 years. On the next slide, we will put it all together to determine the annual benefit for this member. To complete the calculation, the member would determine their total years of service and multiply by the appropriate final compensation and benefit factor. On the screen, you will see how we use each component to arrive at our annual basic benefit amount. For our non-hazardous example, let's assume this member is KERS, retiring effective September 1st, 2038, with 30 years of service. We determined earlier that this member's final compensation was $42,100. So in order to calculate the benefit, we take $42,100 multiplied by 1.75% multiplied by 30 years to arrive at $22,102.50 per year. For our hazardous example, let's assume this member is CERS and retiring with 25 years of service. We determined earlier that this member's final compensation is $44,000. So in order to calculate the benefit, we take $44,000 multiplied by 2.5% multiplied by 25 years to arrive at $27,500 per year. Again, by logging into Member Self-Service, you can project the first eligible and first unreduced retirement date, calculate the member's retirement benefits, and include any penalties associated with early retirement. Tier 3 benefits are also calculated from a formula, but the formula looks entirely different than the Tier 1 and Tier 2 calculations. Tier 3 is the member's accumulated account balance divided by an actuarial factor. The accumulated account balance is comprised of 4 pieces: member contributions, employer pay credits, base interest, and upside sharing. As mentioned before, a non-hazardous member's contribution is 5% of creditable compensation plus the additional 1% health insurance contribution, or HIC. A hazardous member's contribution is 8% of creditable compensation plus the additional 1% HIC. And as a reminder, the 1% HIC is non-refundable should a member terminate employment and take a refund of their account. The employer pay credit for non-hazardous member is 4% of creditable compensation, while the employer pay credit for a hazardous member is 7.5% of creditable compensation. A base interest of 4% is applied at the end of each fiscal year and attributable to both the member contributions and the employer pay credit. And lastly, upside sharing interest is an additional interest credit that may be applied to a Tier 3 account assuming certain criteria has been met. We'll discuss that criteria more in detail in just a bit. To determine your monthly retirement allowance, you must divide the accumulated account balance by the actuarial factor correlated to your age and type of service. Member Self-Service simplifies the accumulated account balance calculation. It will quickly compute a retirement benefit based upon the specific variables assumed within the benefit estimator. It's important to know that these factors are subject to change based upon actuarial studies and updates to the death tables as a result. To better explain the concept of upside sharing, let's read this slide together and look at an example. Upside sharing interest is the additional interest credit that may be applied to a Tier 3 account. It is not guaranteed. The following conditions must be met before upside sharing interest is applied. The system's geometric average net investment return, often referred to as gainer, for the last 5 years must exceed 4%. If this is true, the member is eligible for upside sharing credit, assuming he or she has been active and participating in the fiscal year. If the gainer exceeds 4%, the member's account will be credited with 75% of the amount of return over 4%. It's applied to the account balance as of June 30th. Now let's look at an example. The example shown is an upside sharing credit calculation to better explain this calculation. Let's assume a gainer of 7.5%. Remember, upside sharing is only awarded to an account if the gainer exceeds the 4% base interest. Any return in excess of the base interest is used to calculate the additional upside sharing amount. Once we subtract the 4% base interest from the 7.5% gainer, the returning excess is determined to be 3.5%. The previous slide reminds us that KPPA awards 75% of any return in excess of the base interest to the member's account. 3.5% multiplied by 75% gives us an upside sharing interest of 2.63%. When we add the 4% base interest back to that number, the account's total interest paid is 6.63%. To calculate your benefits assuming upside sharing, you must log into your Member Self-Service or MSS account. It's important to calculate estimates assuming no upside sharing to be conservative and then compare with upside sharing to show how that interest can impact your benefits. Only in Member Self-Service can upside sharing be assumed. If a counselor prepares your retirement estimates, upside sharing cannot be calculated. Your accumulated account balance is divided by an actuarial factor to calculate your monthly life annuity option. Your age at retirement and type of service, hazardous or non-hazardous, determine the actuarial factor. Experience studies are performed by the system's independent actuary at least every 5 years to compare each plan's actual experience to what has been expected, the assumptions. The most recent study was completed in April of 2019. Based on that study, actuarial factors were adjusted effective January 1st of 2020. I've provided a sample of the actuarial factors on the slide, but for a full list of factors, please go to the KPPA website at kyret.ky.gov. A common question for members within the systems is what happens if I leave my job? For Tier 1 and Tier 2 members, your options may look a little different than Tier 3. If you terminate your position, you may retire if eligible, leave the contributions with KPPA until you have reached retirement eligibility based upon age, or if you regain employment in another participating agency within one of the systems operated by KPPA, or you may take a refund of your account. By taking a refund of your account, you receive a one-time payment representing the money you contributed plus interest. The money your employer contributed will remain with KPPA. Refunds may be issued in a lump sum payment or rolled into another qualified retirement plan. And lastly, KPPA is required to withhold 20% for federal taxes, and you could be subject to an additional tax such as a 10% excise tax. It's also important to note members that refund or roll over their contributions with KPPA will forfeit all future benefits, including their benefit tier. Therefore, if they were to return to another employer under KPPA, they would participate within the benefit tier based on their new participation date. If a Tier 3 member terminates their employment, they have similar options as Tier 1 and Tier 2. They may retire if eligible, leave their contributions with KPPA until they reach retirement eligibility, or regain employment with a participating employer of one of the systems operated by KPPA, or they may take a refund of their account. Tier 3 member refunds are broken into two categories, vested and non-vested. Vested refunds are for members which have at least 60 months of service at the time of separation from the participating employer. Non-vested refunds are for members which have less than 60 months of service at the time of separation from a participating employer. Members who are vested are eligible for a refund of their accumulated account balance. The accumulated account balance is the total of all member contributions, employer pay credits, and all interest credited to both amounts. Members who are not vested are eligible for a refund of the member portion of the account balance. This includes the member's contribution interest and upside sharing interest. A non-vested refund does not include the employer pay credits, upside sharing interest, or the interest on the pay credit balance. Like Tier 1 and Tier 2 refunds, members can be paid directly, or members can roll over funds to another qualified retirement plan. KPPA is required to withhold 20% for federal income taxes, and you could be subject to additional taxes, such as the 10% excise tax. For Tier 1 members with a participation date prior to July 1, 2003, KPPA pays a percentage of the monthly contribution rate for medical insurance coverage based on the retired member's years of service and type of service. Each year prior to the open enrollment period, KPPA's Board of Trustees establishes the contribution rate for the following plan year. The monthly contribution rate is based on single coverage under the insurance plan approved by the Board of Trustees. This table shows a breakdown of how the percentage paid is determined based on years of service at retirement and the member's type of service. For hazardous members, the percentage paid toward couple, parent, or family coverage is based solely on the amount of service that the member has in an approved hazardous position. You can find this reference table by going to the KPPA website and choosing Retirees, then Insurance. Tier 1 members with a participation date on or after July 1st of 2003 through August 31st of 2008 shall not be eligible for health insurance benefits until the member has earned at least 120 months, 10 years of service in a state-administered retirement system. Tier 2 and Tier 3 members shall not be eligible for health insurance benefits until the member has earned at least 180 months or 15 years of service in a state-administered retirement system. Insurance benefits for all members with a participation date on or after July 1st, 2003 are determined by meeting the requirements of the dollar contribution plans. Non-hazardous members participating in either of the dollar contribution plans will earn a monthly contribution for insurance of $10 for each year of earned service. Hazardous members participating in either of the dollar contribution plans will earn a monthly contribution for insurance of $15 for each year of earned service in a hazardous duty position. It's important to note that under either of these plans, the monthly insurance contribution will be increased on July 1st of each year by 1.5%. The annual increase shall be cumulative and continue to accrue after the member's retirement for as long as the monthly insurance contribution is payable to the retired member or beneficiary. To see current monthly insurance contributions, refer to the notes at the bottom of the PowerPoint slide, or you may find the information by going to the KPPA website. If a retired member is receiving a monthly benefit based on at least 48 months or more of service, including combined service with KERS, CERS, or SPRS, he or she is entitled to name a beneficiary for a $5,000 death benefit payable upon his or her death to an individual, estate, funeral home, or trust. This benefit is not a form of insurance since there's no policy. With the $5,000 death benefit, the member can name a beneficiary other than the person named for the monthly benefit. A retired member can change the beneficiary for this benefit at any time by completing and filing a new Form 6030 or death benefit designation. The $5,000 death benefit is subject to federal income tax and may be eligible in certain circumstances for a direct rollover to defer taxes. Member Self-Service has some new tools to help members prepare for retirement. We hope you give them a try if you haven't already. By logging into your Member Self-Service account, you can update your contact information, request an account balance letter, calculate a benefit estimate, and even apply for retirement online and upload documents such as your beneficiary designation form. MSS also includes internal messaging center where you can access KPPA correspondence as quickly as logging in. For new hires, you can expect to receive a welcome letter from KPPA with a 4-digit personal identification number to follow. This 4-digit PIN is exclusive to your KPPA account and will be required to discuss confidential information with a counselor over the phone. For those members that are new to the agency but not necessarily to KPPA, you should have received a 4-digit PIN upon your initial participation date within one of the systems. If you are unable to locate that PIN, I encourage you to log into the screen for MSS and click Need to Register. There you will be prompted in Step 2 of the registration process to request a new PIN via email, or it may be sent to your physical address on file. Also, make sure to like KPPA on Facebook, follow KPPA on Twitter, and look for YouTube videos online for more information regarding your retirement benefits. Of course, it's important to visit the KPPA website at kyret.ky.gov for all of our publications, self-service sites, and announcements regarding your retirement benefits. You can speak with a benefit counselor by calling the KPPA office at 1-800-928-4646. You may send your general questions or concerns to the KPPA email address at kppa.mail@kyret.ky.gov. Remember, this is not a secure site, so we ask you to refrain from sending confidential information to the inbox. Of course, it's important to keep your email address up to date for special announcements, registration opportunities for live webinars, member newsletters, and more. KPPA's physical and mailing address is 1260 Louisville Road, Frankfort, Kentucky, 40601. Our legal notice concludes our new employee orientation webinar. We will stick around as long as needed to answer your questions. This, of course, is intended for general information reference only, so if you do have specific questions regarding your account, please contact us at the 1-800 number listed on the screen. On behalf of myself and other KPPA staff, we thank you for attending today's webinar.